from time to time, it's necessary to stand back and look at why current prices are unsustainable and what a bargain both gold and silver are right here, right now.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
Welcome to Live from the Vault TV. As you can imagine, the Live from the Vault community keeps growing, and we really do appreciate that from the entire Live from the Vault team worldwide. There's a lot to talk about during these historic times, and Andrew Maguire is in the house, and we'll be talking gold in just a few minutes here. You're not going to want to miss any part of this episode, of course. And just before we go to talking gold with Andrew Maguire, please keep spreading the word about this channel by liking, by sharing, smash that subscribe button, and then click on the bell if you'd like to be notified as these episodes go live. So with that, let's head over to the UK and talking gold with the one and only Andrew Maguire. Andrew, as always, we start off analyzing the short-term gold and silver action between episodes and where we are in the ongoing battle between the paper and the paper gold and silver markets and what is known as the wholesale markets. Can we start the call off tonight by talking about that?
Yeah, great. And nice to be with you again, Shane. And yeah, this is a good place to start. And actually, much like last time, I think we look really at the silver market. And of course, silver lights up your eyes every time I mention silver. But it really is, the silver market is very, very helpful in helping us to discern this massive divergence in between the paper and the physical disconnect in gold and silver. So we use silver as an illustration of how the all watched, for example, the COT report, for example, which a lot of people will look at, and it's a primary tool that people use, and it's also used by insiders to wrong foot all the non-insiders, the punters in the casino, basically. And what it is that outside of this casino, anyone that's operating in this casino, for the most part, has no visibility into what we're trying to provide you here is an insight into the wholesale side of the market. And so what we're seeing is, and we kind of talked about this a little bit last time, what we're seeing is the market making insiders, i.e. the house, who are visibly logging short positions. Now, when we go on to the COT report, and the delayed COT report was just published on Monday, and it shows a massive amount of short interest coming in, i.e. people betting against gold, or what appears to be them betting against gold and silver. And then really, but what this silver market is telling us, what it is telegraphing, because it's a smaller market, we can actually, and because we know the participants are so much more visible, what we find is that these same insiders that are logging positions that look to be short, they're actually hiding, they're offsetting short positions with unreported long positions in the spot related physical markets. And we see them, this is the point, we see them active in the physical market. You look at the COMEX and you see, hang on a minute, why is all this short interest appearing? Now, that wrong foots a lot of people. It's designed to do so. So the example that we're talking about became evident based upon the absolute certainty that spot silver, liquidity provider, and COMEX market maker, we talked about them last time, Standard Chartered, Indian Bank, but a market maker on the COMEX, were aggressively chasing every single ounce of global wholesale silver supply, and it commenced on the exact day and at the exact same times to the tick, to the second, where we saw a free fall of short positions coming into the market. Now, that was on November, if you go back to your charts, have a look, that was when the lows were made. And that was on November the 2nd and 3rd, and the low was made at 23.045. That's about $2 lower than while we're recording this on Tuesday the 16th of November. Now, look, it's really rare to get such a clear intraday window into this smoke and mirrors world of this COMEX, of where the COMEX insider footprints are evident. And what it does is give us a window into these same actors' footprints in gold futures. And as is the case, these deliberately hidden footprints were exposed directly as our suppliers were reporting live these unprecedented large forward purchases as they unfolded real time. And as we discussed last time, during this mega physical buying process, this is unprecedented since March 2020, basically. We've not evidenced that since then. And all the blinkered COMEX-centric traders saw from their side of what it corralled in this house was the related short COMEX positions coming in, unrealizing that they were hedged, tricking these wrong-footed speculators into momentum selling their silver into the insiders' hands. Look, if you're going to see tons of sell orders coming in and you see the price cascading down, you know what? Unless you are an insider or a stacker, if you're playing the paper game, you will dump those positions. And that's exactly, you ignite the free fall that enables you to do that. Now, it wasn't just Standard Chartered locking in 2022 forward production. No, I'm not saying 21, 2022 forward production. We've also received reliable reports that every single market-making bullion bank with a view into the tight wholesale market has moved in to mop up every single available ounce, not actually contractually locked down, i.e. if we've agreed at the beginning of the year to buy a minimum or a maximum amount, unless we've actually bought that, now they've removed the option of actually taking what we had guaranteed we would take. So anything above that is gone. Now, in fact, buying in the tight wholesale silver market was so aggressive and continues to be so that Standard Chartered were offering record large premiums over spot to front run all supply, and that was not already, as I say, contractually locked down. And then once there was nothing left that was not previously locked down, this COMEX-centric market-making bank paid very large premiums to buy forward production and to also front-run physical supply deep into 2022. Now, what's not filtered through to the non-insider paper silver market participants is that this vacuum in supply will leave global refiners struggling to provide silver to the general public and the general market in 2022. And this supply deficit will drive the bid price to buy physical silver high enough to attract a seller. That's how a market works. With the retail price once again soaring. And if you remember, we had that arbitrage process kick in March, April of 2020. We're going to see the same thing again. We're going to see the coins and the smaller bars starting to rise in price. And that's a kind of a bottom-up effect, and that in turn will drive wholesale prices significantly higher. Now, given next week's COMEX options structure still does not reflect this paper to physical pricing imbalance, not as of this morning, we view the current enormously discounted prices through the same lens as every single COMEX market and spot silver liquidity provider and market maker, grossly underpriced and coiled for a much larger move. And that's what they're positioning for. So the current options imbalance reflects some very large offside bearish bets, probably many of those made a year ago or many, many months ago, into an inflection point not experienced since pretty much April 2020. And if we draw a wholesale market comparison, silver was trading $11 lower at around 13.9 just before silver launched into a 4-month physically driven $16 rally into $30.90. Just like back then, we expect, some volatility, which we saw then, but there's very little liquidity, open interest to rinse out. So dips will be shallow and extremely buyable. Now we're seeing this again today. We're seeing some gaming, but it's just to do with options. And as we summed up last time, momentum-driven silver futures sellers, along with tricked in spec short sellers, they don't see that the largest silver buying against the tightest silver shortages evidenced since March 2020 are actually upon us now. And the short-term volatility we're experiencing is the specs reacting to the blinker view that of just one side of the transaction, namely that the short sold gold hedge positions being added from the likes of Standard Chartered and others who are sneakily going along spot and physical over-the-counter silver positions. This is driving the paper physical disconnect to extremes. And as said, I have to draw attention because this is not seen since March 2020. And this is a massive opportunity to buy silver before this wrong-footed, capped, coiled paper market closes the 2012 gap, which is a 10-buck gap higher into the 35s. And really, everyone we speak to is looking at that gap to close. And this easier to read insight into the insider's footprints in the silver markets reveals what they're also doing in the deliberately opaque gold market, which is harder to read, same actors. Therefore, when we look at this COT report and look at the one that was just released on Monday, look at all the massive amounts of short interest that came in. You have to factor in what we're also seeing in the physical gold markets, which are in massive central bank sovereign and insider accumulation. Now, please bear in mind, when reading this report, the published net short interest that deliberately force out speculators represents just that one side of the transaction, and that these gold futures shorts also are one-to-one hedged in the unregulated, opaque spot over-the-counter markets. And this makes an absolute farce of the report, especially when insiders plan their largest weekly moves to take advantage of a 3-day blind window between the Tuesday and the close of business on Friday in a picosecond world. This is ludicrous. But by the time this report is published, it is so grossly out of date, while insiders have easily publishable withheld data daily. They are seeing this data today. Now, what the report does do is provide us a view into how the casino uses these purposely disseminated data to wrong foot as many participants as possible, while we balance it up against how the house market makers are positioning in the real wholesale markets.
Well, Andrew, given the current bull-bear volatile price action that we're seeing here, a lot of the subscribers are asking, they tune in every other week and they're looking for that short-term, from 2 weeks to 2 weeks guidance. Can you just tell us what we might expect between now and, let's say, our next episode in 2 weeks?
Yeah, Shane, and I think what's notable is we've evidenced gold rising alongside the dollar. And as gold, because gold is real rate sensitive into real negative yields, we see this as driving in the necessary long paper risk hedges, which are necessary for any gold or related silver rally not to be gap closed. So what we're saying is it requires both the paper and the physical markets to rise in tandem. And that creates this stair step, which is hard to close the gap. So, and then that's how you can sustain a large rally. That's what we saw back in 2020. Now, we currently have these conditions now, which have not been seen since the 1970s, actually, and most recently structurally, as we evidenced in March 2020. So if we look at the foreign exchange crosses, we're going to know that gold is a foreign exchange cross. So is silver. You're long one side, long gold, short the dollar, long the dollar, short gold, etc., etc. So when we see gold rising alongside the dollar, it's because of safe haven flows into gold are really largely offsetting this plain vanilla inverse algo correlation between buy gold, sell the dollar, or buy dollar, sell gold. So it counters that FX cross. So this rally into what are really plain vanilla bearish crosses is largely physically driven. That's why, with physical buying keying off the inflation fears, really reflected by deeply negative real yields.
Now, Andrew, you've been extremely accurate on weighing up where the magnetic BIS monthly options sweet spots are. Given that we have a November expiry coming up, we had some questions again on where do you think that this sweet spot may be for this month?
Yeah, and I think this is important because as we telegraphed into October expiry, and we assessed that this spot gold sweet spot had risen from the September sweet spot. If you remember, that was 1750, 1775, and it rose into, we saw it rising into the 1785 level, which didn't seem much, and I made a bit of a deal of this. I said, okay, it seems insignificant, but when you consider that each dollar has to be squared, to market, represents billions of dollars of derivative positions. So really, that was a big deal. But by no surprise, after overshooting this level into the 1820s, into October, this is where it settled back to at the end of October. And then in our last episode, 2 weeks ago, we estimated that this month's BIS sweet spot would be higher again. And we figured probably somewhere between 1815 and 1830. That's quite a big jump. But this is the key. What we would likely, and what I said was, look, obviously we're going to get this overshoot because you've got momentum, and we have had an overshoot, and as we have, but possibly we figured possibly, okay, that'll probably be brought back down to this level. Now currently we see this sweet spot at 1835, but with March 2020 wholesale conditions evident and very strong competitive central bank buying, so any overzealous attempt to cap gold is going to backfire and coil it for a test of the 2000s.
So, Andrew, where do you think this 50-year leveraged paper game is going to finally end? We get that question a lot.
It certainly is a good question. And really, what does that do? That brings us right back to Basel III. And, you know, we haven't talked about that for a while, but and there's a lot of misinformation out there right now. And as we've drawn attention to previously, other than this 6-month extension granted the LBMA local London markets, every jurisdiction, including the COMEX, is already Basel III compliant. Now, in so much as they adhere to NSFR rules. Now, the back door that actually perpetuates the continued gaming that we are seeing is the related 6-month extension. The LBMA unallocated gold markets were given to become compliant. Now, as we've highlighted previously, due to global competition from primarily the BRICS countries backing up their respective currencies with physical gold, ultimately the Eurozone and the BIS will benefit from, and indeed will require, a stronger gold price to protect their rapidly depreciating dollar holdings. Now, the issue we're running up against into this rapidly closing window is that until then, these over-the-counter unallocated long so-called hedges that we were talking about are accepted by the CME and the CFTC as a COMEX short position offset, which essentially allows the Basel III compliant COMEX market to continue as a paper market. And due to the fact that these offsets are accepted, but they're not physical. But that's going to change on the 31st of December.
Now, Andrew, just before we started recording today's episode, you were talking about the mechanics of a gold market revaluation. Can you just update our subscribers on this whole concept, please?
Yeah, Shane, that brings us right back to this, as you say, gold revaluation discussion. And as we know, look, the Fed doesn't hold any gold. It holds gold certificates. The certificates are issued by the Fed, to the Fed by the US Treasury, who claim to hold these, well, unaudited physical reserves. Ask Moody, who wrote to the Fed and asked for a disclosure. Never got a response. But I mean, hey, this is supposed to be unaudited physical reserve. But this relationship. So leaving aside that this is probably rehypothecated, this is a smoke and mirrors relationship. So even if you accept that that was there, not rehypothecated, which I honestly don't believe it is. I believe it is rehypothecated by revaluing the 8,133 tons of gold held by the US. It's at currently 11 billion. It allows the Fed to have a paper claim on all this gold at $42 an ounce. Now, gold's been revalued twice in the last 100 years. The first revaluation was in 1934 when the gold price was repegged from $20 and a half bucks to $35, effectively increasing the gold on the Federal Reserve's balance sheet by close on 70%. And this increase in assets allowed the Federal Reserve to further inflate money supply. Hey, does that rhyme with anything right now? And the second revaluation was in 1973. That was 2 years after Nixon safely ended the convertibility of the dollar to gold. So if the Fed was to mirror this previous close on 70% gold revaluation, it would raise the $42 price to over $70. But based on today's price, technically this would force a treasury price of about $3,200. And that still looks far too cheap to accommodate Basel III's NSFR, which will morph gold credit positions into a cash-settled, physically settled marketplace. Now, the question now is, with Basel III about to value physical gold as real cash equivalent, is it time for the Fed to revalue gold certificates to market to accommodate trillions of dollars of money supply and simultaneously to protect the dollar hegemony? Now, if gold was valued at 1900, close to where it is today, the Fed would only have a claim on just a couple of tons, like maybe 18 tons of this 8,000 odd tons of US gold reserves. Now, obviously, this is an inside arm's length agreement that currently insulates the Fed, allowing them to maintain monetary control without the danger of political interference. Insulating gold from its real price keeps the power in the Fed's hands for now, negating the likes of Macron in France, who's trying to currently sell gold reserves for political reasons. So let's not forget that the whole objective of NSFR is to force banks to finance long-term assets with long-term money to avoid liquidity failures that threatened the entire banking system following the 2007-2008 global financial crisis. Now, given gold derivatives comprise some 70 trillion of interbank counterparty risk, there's just no going back from this directive. It's too big. And there's a lot of differing opinions on the impact that these standards will have on the gold price. Every negative spin we have seen or heard results from these changes being viewed through the lens of this 50-year cash-settled legacy market. People are in the casino. They don't look outside it. Namely, it is the price benchmark against the COMEX cash-settled futures market, which was born out of necessity, as I say, 3 years after Nixon closed this gold convertibility window in 71. So in 1971. So the problem stems from the fact that the LBMA and the World Gold Council and the current legacy system does not differentiate unallocated gold from allocated gold. Sorry, but we have to briefly dig into some technicals here, because what it revolves around is the argument revolves around the published basis and co-basis data, which determines how the GOFO rate is set. And so the difference between basically LIBOR and the gold lease rate. And this reflects the paper to physical anomaly really well. And by adding or reducing undeliverable gold open interest, officials governing the price of gold against the dollar have tricked the legacy market players into benchmarking their trades upon it. And it's also the basis for those who argue that Basel III will be bad for gold. And for the last 50 years, as you allude to, Shane, one unallocated gold market has been used to hedge with the other. And it's quite evident that the LBMA's begging letter that we saw a few months back, where they managed to get a 6-month extension, was really attempting to argue the toss that this risk weighting perspective that these high counterparty risk unallocated gold positions clearing 600 odd tons of unallocated gold a day should, under Basel III standards, not be segregated from the 1 ounce of cash equivalent tier 1 physical gold that underpins the high counterparty risk 100 to 1 unallocated gold position. So while Basel III global compliance has been extended, it is not the case for gold. So a lot of people have said, yeah, it's been extended a few years out, not for gold. Raising funding requirements for unallocated gold means a financial institution would either reduce or exit the bullion business. And if you remember, the Bank of America said at one point, what it's going to do is sustain activity and put more funding aside. However, that argument, so yes, okay, so the argument is you could do it, you could fund it, you could keep the game going. But excuse me, then it becomes bloody expensive, and it's going to reduce an awful lot of liquidity if you have forced to roll those things onto your balance sheet. So look, we could look in more detail about it, but look, if rising costs for market participants is going to be determined by the cost of financing precious metals production, but without incurring counterparty risk. So this simply means that the cost of such financing will have to rise to the extent that these forward transactions can be backed by real hedged physical gold. And all this means is that the end user price of physical gold will have to rise to meet this cost. There is absolutely no requirement to see 1/3 of all mine production cleared and hedged in London every day. The volumes of gold cleared every day will dramatically reduce. So this is a good thing for the gold market, as paper dilution will dissipate and a true physical price demand price will ultimately emerge. Now, equally, there's no requirement to see 9,300 tons of joined at the hip silver cleared amongst the LBMA members every day in London. So really, I really don't want to get into the technicals because I know a lot of people glaze over it, but under the covers, this co-basis, which is simply the scarcity, tells us a story of a mismatch between current prices and physical supply. And this condition has resulted in physical rehypothecations of central bank lease swap gold currently being unwound into Basel III and SFR standards. And we're talking 7 weeks till their compliance. So, I do apologize for the technical dive this week, but from time to time, it's necessary to stand back and look at why current prices are unsustainable and what a bargain both gold and silver are right here, right now.
All right, Andrew Maguire, thank you so much for talking gold there from the UK. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Listen, you're not going to want to miss next episode as well. Why? Because we have Danielle DiMartino Booth coming up. She's distinguished by a career on both Wall Street and the Federal Reserve. So with that, please help keep spreading the word about this channel by liking, sharing, subscribing. Click on that bell if you would like to be notified as these episodes go live. And with that, we'll see you next time on Live from the Vault. Bye for now.